having investments that generate cash flow, be it rent, dividends, interest, and that allows us to get some level of predictability just based on the cash flow versus speculating on Bitcoin or speculating on some meme stock. Cash flow is very helpful to sort of staying grounded and getting some level of certainty regarding our investments, irrespective of what the price might end up being, because we know we're getting at least that income component.
Yeah. Welcome to the Real Estate and Financial Independence Podcast. I'm your host, Chad Carson. You can also call me Coach, and this is a show all about helping you get out of the financial grind so you can do more of what matters. Whether you're a first-time listener or a long-time listener, I want to thank you for being back for another episode. The title of this episode is Inflation, Gambling Disguised as Investing, and Living Without Money Worries. This is a conversation with David Stein. He is the host of the Money for the Rest of Us podcast. And I have to admit, this is a treat for me. David's show is one of the few money podcasts that I listen to on a consistent basis. He's a really smart guy who used to manage billions of dollars for investment foundations, for universities, and he now does it for himself. He doesn't work in that field anymore. He manages his own money, and he talks on his podcast and on his website about principles that he uses to both succeed as an investor, but also to have peace of mind about your money. And so I found a lot of useful tips from him. And in this conversation, we talk about some of the current events. The end of the conversation, you have to wait around for that. We talk about inflation, what's going on with that, how do we look at that, how do we understand that, and how do we approach it as an investor. But we also talk about core principles. And this is one of my foundational principles, whether I'm doing sports or whether I'm doing real estate investing. I like to talk to intelligent people and ask them, what are the fundamentals? What are the core things, the first principles of your investing? And so we talk about his investing philosophy and how you approach that. We talk about the difference between gambling and speculation and investing. This is such a valuable idea that I hope you take away a lot of useful tips from. We also talk about his approach to diversification, and it's a little bit different than I've heard from other people, and I would say it's something I identify with and approach myself. I'm not just a real estate investor. I also invest in index funds. I also have a little dabbling in a little bit of other things like cryptocurrency and some personal investments in some businesses. And we talk about his approach, something he calls asset gardening or investment gardening, where you take this approach of having some investments over here, some investments over here, and I'm gonna let him explain that so you can understand it. But if you're just interested in your overall financial picture, personal finance, how real estate fits into that, this is the conversation for you, and I hope you enjoy it. Now, before we get to the interview, it's time for my weekly behind the scenes segment where I share a short snippet of what's going on with me and my real estate investing, my business, or my personal finance behind the scenes. This week, I want to talk about diversification. So investing in real estate is one asset class. It's one type of investment. It happens to be my favorite, and it happens to be something that I have concentrated a lot of my time and resources in over the year. And for most of us, I think that's actually a reasonable approach where you put all of your eggs in one basket for a little while you concentrate on it and grow and get good at it. And a lot of business owners, some of the wealthiest business owners in the world do that. They focus. But eventually, and this has been something on my mind for the last probably 5, 6, 7 years, is working on diversifying my overall investment portfolio. So my wife and I have retirement accounts. And while we used to invest a lot of that or almost all of that in real estate-based assets, I actually lately have almost all been going into index funds, into the stock market, into equities, which if you just break it down is basically in other businesses that aren't in real estate, and they have geographic diversification. And so that introduces this idea of diversifying your investments. So eventually, if you want to make sure you don't have too much risk in one market, in one asset class, it's a smart thing to do to not put all your eggs in one basket. So again, starting off concentrated, you got to grow somewhere, you got to start somewhere, but eventually open up some other baskets, put some of those eggs in other baskets. For me, it's things like equities, like owning big, broad index funds and having very low expense ratios. That's one I really like. I'm also dabbling in other little things that I don't necessarily recommend. I'm learning about them, and sometimes I have to invest in them to learn about them. Some crypto assets like Bitcoin in particular. I'm intrigued just by the long-term potential of the money for maybe an international internet kind of currency. I've traveled to other countries where I think having a financial system like ours isn't a given, where there's having access to money, banking, currencies. That's a whole nother conversation. Maybe I can do another episode on that at some point. Again, not recommending you invest in that. It's something I'm learning about and have a very small percentage of my overall portfolio. But the point is that real estate in one town is great for a while, but you want to diversify. And so that's something I have been working on. And it's a slow process. It's not something I'm doing overnight. And I think you'll enjoy this conversation with David because there's different approaches to diversification, and his approach to it is a little bit different. It's probably more one that I resonate with, and the style of it and how you apply it and how you do it. He calls that his asset garden approach. So definitely listen to that part of the episode. It's something I took notes on and have learned a lot from him on. But I wanted just to point out in this part of the episode that diversification is something I'm working on behind the scenes, and it might be something you want to think about as well. If you like these behind the scenes segments each week, I want to invite you to stay in touch with me beyond the podcast by checking out one of the online courses that I offer. Online courses are a way to interact with me and let me help you go in depth with your real estate investing. Some courses are available anytime, and others, like my premier course, Real Estate Deal School, are more of a boot camp style course where you and others go through live with me as I help you step by step in purchasing your next investment property. You can get details on all of these courses at coachcarson.com/courses. Now let's get started with today's interview. Hey, David, great to have you on the podcast.
Hey, it's super to be here. Thanks for having me.
Yeah, this is my pleasure. I'm a listener of your podcast and really enjoy your episodes and the value you bring. And I actually have your book as well. So I was fortunate enough to get a copy of that when you wrote it. So I'm going to put links to both of those in the show notes. And I thought I would get started, David. I found it interesting with your story that you kind of in another life, in a professional life, you managed billions of dollars for institutions and for universities, I assume. And now more kind of your current world with your podcast and what you do is managing your own money and also helping other people do that. And I really recently enjoyed one of your episodes that talked about an investment philosophy that when you manage your own money, you've got to start with having, I think the name of the episode was People Like Us Invest Like This, like having an approach that makes sense for yourself and a kind of an overall just investment philosophy. And I was wondering if maybe we could just start there just to help people get to know you a little bit better. Could you talk some about your own approach to investing or your philosophy from that standpoint?
Sure. And I think, as a professional money manager, and I actually had lunch with one of my former partners just last week, and we were talking about this. Clients, when you're managing money, think you can predict the future. Like, and they want that. They want an advisor that knows what's going to happen because there's a lot of stress with your own money. Like, what if the market's down another 3% today? What if that continues? Like, and all that anxiety causes people to want to hire an advisor that can make them feel better. Whereas now, once I left that, my approach is, I don't know. And that's what I lead with. Like, nobody knows what's going to happen because the world is a complex adaptive system with all types of different inputs, interactions, and it's really unpredictable. And so my investment approach starts with, well, I don't know what's going to happen, but at least I know where we are. So I know what current conditions are. I know what the valuation is for the stock market. I know what interest rates are. I know how pricey real estate is. And so all of those inputs allows us to know kind of here's where we are, and then try to make the best decisions based on the market's temperature or the financial market's temperature. How zealous are investors right now, or how fearful are investors? But the basis of that investment approach is not knowing and being comfortable not knowing exactly what's going to happen. And then making sure when we make investments, it's not dependent on accurately predicting the future, which many investments are. So we want to play the probabilities and not be dependent, our financial success dependent on predicting a future which is unknowable.
I think when some people hear that, and maybe my initial impulse too was, well, what do you mean I can't predict the future? Or how am I supposed to invest when things are uncertain? Like the extreme response to that might be, well, I can't do anything, can I? Like, because if I really don't know what's going to happen in the future, how am I going to make decisions? And you told a wonderful story in the book that I think brought it home for me about weather forecasting. And I was wondering if you could tell that story about, the weather forecaster, and I think it was a summer storm in Idaho or something, and how there is some predictability there, but they didn't know exactly what was going to happen.
Well, right. So in the story, it happened to be kind of a pop-up thunderstorm that ended up dropping 2 to 3 inches of rain, which in that part of Idaho is almost 20% of their rainfall in one storm within a couple hours. And our neighborhood flooded. But the idea is that we don't know exactly when a storm's going to hit, but we know when a low pressure system's coming in, or we know when it's getting cold, or winter. We dress different in the winter than we do in the summer, and we can do the same thing with investments. We can look at, take real estate for example. We can see, all right, here's what cap rates are for apartments, and we know that, well, cap rates are 9-10%, and that's the type of yield I'm going to get. That's a much better environment when we're bidding on properties with cap rates of 4 or 5%, because there's less of a buffer, and there's less of a margin of safety. And so when I talk about investment conditions, it's just being aware of where we are in the cycles, because financial markets go through very long cycles, and we don't have to be experts, but we need to have some just rudimentary knowledge of, like, here's where we are. Just like if you go outside, you check the weather, and the weather forecasters are often wrong specifically, but generally, within, you get a temperature range, if it's going to be windy or not. Maybe it'll rain, the probability's up, and we can approach investing sort of the same way.
So it sounds like we can gather information, we can take the temperature, and we can make reasonable decisions investment-wise with our money without having to have perfect predictive power. Like it's still possible to do that.
And one way that I do it, and many investors do it, is by having investments that generate cash flow, be it rent, dividends, interest. That brings some predictability, because when there's cash flow, not only are we capturing some of that return from that cash flow, but we can also evaluate, what are people paying for that cash flow? Are they paying a lot more, or are they paying a lot less, depending on the environment? And that allows us to get some level of predictability just based on the cash flow, versus speculating on Bitcoin or speculating on some meme stock. So cash flow is very helpful to sort of staying grounded and getting some level of certainty regarding our investments, irrespective of what the price might end up being, because we know we're getting at least that income component.
Yeah, speaking my language with the cash flow and the income, for sure. So that might be a good segue. One whole chapter of your book, which, by the way, for people who haven't read that, it's an investment framework where you ask 10 questions. And I love that, because it's something I keep going back to. If I'm looking at an investment, I'm like, well, what are the questions I need to be asking about this investment, whether it's real estate or stocks or a bond? And one of the chapters was, is this an investment? Is this speculation? Or is this gambling? So can you explain that kind of rule of thumb, or how that might be helpful, whatever we're investing in?
All right. So an investment would be something with a positive expected return. So it's going to be positive, and typically it's positive because there is cash flow. So if you purchase an apartment building, because it's paying rent, well, generally it's an investment. There's a positive expected return, even if when you sell it, maybe you sold it for less than what you paid for it, but because you're getting the cash flow, it could still end up being, slightly positive return. A gamble is something that has a negative expected return. If you go to a casino, you go to Vegas, the odds are stacked against you. You are betting against the house, and you can't have a positive expected return with gambling, because casinos would go bust or bankrupt. You don't have an edge there. And then a speculation is somewhere in between, where there's disagreement on whether the return will be positive or negative. An example would be Bitcoin or other cryptocurrencies, where it's a zero-sum game for every buyer. There's a seller. There's no cash flow. The asset will do well. Bitcoin will do well if people trust it more, use it more, and then it'll go up in price. But if they don't trust it more, there's another competitor, or it falls. And so it's very much completely dependent on what people are willing to pay for it, because there isn't any type of cash flow, and as a result, it's more of a speculation.
What's your own approach to how, so we're going back to the story of us investing our own money and managing our own money. Is it just a total, hey, I shouldn't speculate at all, or should I, how do you think about investments versus speculation, and how much most people would put towards those different categories?
Yeah, my portfolio is about 85% investments. So I do have a meaningful position in cryptocurrency. I have a meaningful position in gold, but generally speaking, I want cash flow paying investments. And when we talk about cash flow, let's say momentum or growth stocks, like maybe they're not paying a dividend, but there is the prospect of earnings and cash flow embedded into the valuation of that particular stock. But I use what I call an asset garden approach. So I just have a variety of different assets, just like at the garden, you have certain vegetables, you have certain flowers, that some seasonal, some annuals, not knowing exactly, when a particular flower will bloom. In the same way with an asset, by having just a variety of assets and understanding what the return drivers are, for those assets, like how do they work, what's the expected return, how likely are they to be successful, or what does it take for them to be successful, and build it out that way. But most people, and where some individuals get in trouble, is where they get enamored with a particular, let's say Bitcoin or some other crypto token, and then they suddenly they put a meaningful portion of their investments, like 50%, all of it, for example, and their success is very much, it's binary. Either it's going to go up or it's going to go down. We don't want to be in that situation as investors where it's a binary outcome. We need to have a variety of potential outcomes and stage it that way.
I love the garden metaphor, just as someone who dabbles a little bit in gardening, but just the idea that your investments are, here's a patch of real estate, here's a patch of, corn, or whatever you're going to be planting, but that each has their own characteristics. There's certain qualities that make that investment better or worse. And it's not like that one's right, this one's wrong. It's more like, hey, how diverse do you want your garden to be? Like what crops do you want to come in at certain times? And there's probably a place in your garden for this exotic, weird little speculative plant too, right? That can do well, but you're not going to plant your entire field with that one exotic plant and starve, the next year if you were a gardener. So
They call that monoculture, and you don't want that.
Yeah, it's going to fail at some point, perhaps. But so I really love that metaphor, and as someone who is, I feel like real estate's my game. I really focused on it. It's what built a lot of my wealth. But I've always in the back of my mind, and one reason I like listening to your show and reading your book is I know that diversification in some form or fashion makes sense. It's just there's an intuitive sense to that, like, all right, don't put all your eggs in one basket. But there's also, as you study markets, you study other investments, you're like, well, there's other opportunities out there than just my local real estate in Clemson, South Carolina. So I've always appreciated that approach of doing that. But also I hear so many different competing ideas. Should you have a exact allocation of this much stock and this much real estate and this much bonds, and reallocate it that way? Whereas the garden approach to me, like you are diversifying, but it was a little bit more flexible in that you can run with some investments as they do well. Like if this crop's doing pretty well and you're getting some good deals on that crop, this go with real estate for a while, or so that I think that fits my personality a little bit better than some of the other ones that have go do this way exactly like you want to do it.
Well, exactly, because one of the things as a professional advisor, as I managed endowment and foundation assets and other institutions, what you see is people want certainty. And when they want certainty, one of the things they try to do is they optimize. So let's optimize our portfolio so we get the exact weight. And as investors, you just can't optimize. The world is too complex. What we do as investors is we cope. And so if something's working or we learn a little more about it, we can put more there. So it doesn't have to be, and it's not an optimization problem, because in order for an optimization to be successful, then the inputs have to be correct. In other words, the expected return of an asset class, or how volatile will it be, or how it will move relative to other asset classes, which is called correlation. There's a lot of inputs that go into it, and asset allocation optimization models. Sometimes it's called modern portfolio theory. And the reality is it's garbage in, garbage out. And so my approach is understand the asset classes, understand what you're investing in, have a variety, and there's just not a perfect portfolio, and just diversify it out and go from there.
Yeah. Well, I want to talk about some of the decision framework you do have because, as we talked about in the beginning, you might not be able to predict exactly what's going to happen. You don't know all the inputs that are coming in, but you can make decisions that can optimize your portfolio and optimize your money, so you don't have to worry about it as much. And I love how you have kind of it seems like there's two different paths you go down when you're making decisions. There's the risk path of like, all right, what can go wrong with this investment that I'm looking at? And then there's the upside path about, let's try to quantify, what's the potential for this property or this investment. And I guess I want to start with the downside. Let's go with the risk, follow Warren Buffett's maxim of, don't lose money. How do you approach, or how do you think about an investment? Let's just use a piece of real estate since people will appreciate that a lot. But what is the question you ask yourself, or if when you look at investment, to say, like, understanding what could go wrong with this investment?
Right. So my risk for me, like in traditional financial framework, risk is volatility. So back to that optimization model, looking at what are the ups, what are the downs. Whereas for most of us, the type of risk that we are concerned about is how much we could lose. So that's the first part. But the second part is, what is the potential hit? Worst case scenario, how will our lifestyle be impacted by that particular investment? So with real estate, how leveraged is the particular property? What percentage of your net worth is invested in that? And if it didn't work out, and for whatever reason, the real estate market crashed, or there was some specific event with that property that you weren't unaware of that was uninsurable, now how would your lifestyle be impacted from that? And that's really the approach that I take, which is why you kind of diversify it out, but always look for and consider what is the worst case scenario. Now, for young investors, if you just have a 401k plan, for example, they can take more stock market risk. So even though the stock market, the worst case scenario for the stock market, if it falls 60%, that's kind of been, a broad diversified index fund or ETF, it can have a 60% drawdown. Now, if you're young and you're just starting out, you can stomach that because most of your wealth is not in your portfolio. It's in your human capital, your ability to earn over many, many years. And so that's when we talk about the lifestyle aspect of risk. If you're closer to retirement and you want to leverage up and purchase this building, highly leveraged, that's risky because if it doesn't work out, then you potentially can't retire. And so that's always kind of the way that I approach risk and scaling it.
So from a personal standpoint, the 25-year-old, and I'm thinking about myself when I first started real estate, almost 100% leveraged and, taking a lot of risk in that. Let's talk specifically, like I buy a 4-unit apartment building and I have 5% down, and I move into 1 unit. And then if that building, which was worth $200,000, potentially, it could go down to $100,000 if we had a Great Depression or something. Is that the kind of scenario where we have to specifically think about, like the price could drop, the rents could drop, there's all sorts of things that could happen, and then I would not only would I owe I lose the $5,000 I invested, I would also owe the bank another $95,000 that I don't even have. Like that's the kind of big, huge downside for a leveraged real estate investment.
Well, exactly. And people, not just your audience, certainly not, because you're very much, understand real estate, but many people, when they think about buying their first home, they're always excited about home prices increasing, but they don't realize the reason why home prices increase or why it's such as a big impact is because they're so highly leveraged. We don't think of mortgage as leverage. We just think of that's how you buy a house, but it is a very highly leveraged transaction, and that's important. When I was an advisor, we sold our company and then we bought it back in an incredibly highly leveraged transaction, and where we had to sign personal guarantees, and it was a hard decision for me because then it was probably my late 30s at the time. And so I had some wealth, but this could be a potentially huge wealth driver. And we kind of had to look at the pros and cons of that. And what's the worst case scenario? And in this case, the worst case scenario is we would lose our house or our wealth if for whatever reason, the business fell apart. We went ahead and took that risk and it worked out great. But still, we always have to kind of decide, are we willing to risk that for the potential worst case scenario?
So there's always a risk. Is we need to quantify it or at least imagine what it could be and try to identify those and then decide where in our personal kind of approach could I stomach that. That's where the personal financial decision comes in. And so somebody's earlier in their wealth building career, because they are earning income, they have a lot of time to go. We all take risks, so it might be reasonable for somebody to take that kind of risk, either stock market, real estate, or whatever. Whereas if you've built your wealth, you're closer to having to live off of that wealth, then you're going to have a totally different decision, even with the same property, than somebody who's in a different point of their life.
No, exactly. And the real estate that we've done has been no leverage at all, really, or very little leverage, just because we're at that stage where we don't want to mess it up. And so we're trying to reserve capital. We're trying to grow a net worth greater than inflation. And so we don't have to take, at some point you get to a level where you don't have to take big risks anymore. And some people, that's really hard for them because they like the adrenaline of taking risk, and they want to build a bigger empire. But at some point you have to decide, okay, I'm taking risk off the table, and this is my nest egg, and decide, maybe find other things to do with your life to where you're not just empire building all the time.
Yeah, do it. Jump out of an airplane with a parachute or something if you want your excitement, right? Don't get your excitement out of your real estate. So we could talk a lot more about risk, and I'm going to go back to a couple specific risks that people might be looking at in 2022, like inflation and some other things. But I want to go to the other kind of side of this coin, which is you buy an investment and you try to avoid risk, but you also, there's some reason you're doing it. There's some kind of upside. And particularly in your book, it was really a big aha for me, not because I thought about, an expected return or trying to figure out what a property would return all the time in real estate, but I had never done that with stocks and with bonds. And it just really clicked the way you explained how we think about the upside of an investment. And I was wondering if you could just kind of go to the 101 level in general with what is an expected return, and how do we use that to project in the future looking at our investments?
Well, sure. So let's just take stocks, for example. If you go back through time, let's say the S&P 500 index, which is a measure of U.S. large company stocks, you can decompose that, let's say 10% annualized return going back to 1900. And it's really, there's three components. There's the dividends, which is the percent of the profit that is paid out to shareholders. That's a very big driver. So right now, dividend yields for the S&P 500 is about 2%. And then you have the growth of that cash flow or dividends over time. So it's usually, so the dividends is the cash, and then how quickly are those cash flows growing, or those dividends. In the case of real estate, for example, you know what your rent is or your yield because of that, and then how fast you expect that rent to grow over time. And then the third component is what are investors paying for that cash flow. So in the case of stocks, a common measure is the price to earnings ratio. Dividends are paid out of earnings. And so when investors are looking at stocks, they're looking at the price to earnings ratio. So right now, if we look at, let's say the NASDAQ 100, which is really some of the largest, biggest tech stocks in the world or in the US, so Facebook, Amazon, Netflix, et cetera, right? That PE is over 30. So people are paying 30 times earnings for the NASDAQ 100. Or you could purchase a smaller, higher dividend yielding Japanese ETF that has a PE of 7. And so those are sort of the comparisons. Whereas that Japanese ETF, it has a dividend yield of 3.5% to 4%. You're paying a PE of 7. What we don't know is how fast those earnings will grow, that dividend will grow. But then you compare that to the NASDAQ 100, where the dividend yield is probably less than 1%. I don't have it right in front of me. You're paying 30 times earnings. And so that particular investment is going to have to compound earnings very high in order to justify its price. And so we can do this with any asset class. Just look at, well, what is the cash flow yield? How do I expect that cash flow to grow over time? And what are investors paying for that cash flow? It can be done in real estate. The cap rate is typically the standard that we look at. And if you're involved, for example, in real estate investment trust, you can look at and what's the cap rate for the apartment sector versus retailers versus office building. And so this is what investors do. They it's important to understand, not just throw money at something, but understand what the expected return is based on those inputs.
I'm going to try to re-explain that just to make sure I got it, and also just so people can kind of absorb this a little bit more, because I think it's such a critical piece of information or tool to have. Let's say I buy a duplex, and I pay $100,000 for the duplex. I know no properties are worth that today, right? But just to keep my numbers round, and I make a $6,000 per year net operating income. So I don't have any debt on this property. I'm just making $6,000. So $6,000 divided by $100,000 is I have about a 6% income return on that property. We could call that a 6% cap rate as well. So that's source of return number one. But what we're also saying is with real estate and other assets, there's this growth component, which I always found a little bit trickier to get my head around. But the rents on that property over time are tending to grow. The price on that property over time is tending to grow, often in lockstep with inflation, maybe not, maybe a little bit more, maybe a little bit less. But those are the two primary ways that the property generates revenue: the revenue from the rents, and also the growth of that property over time. The third one being that, let's say this year investors pay a 6% cap rate on this duplex, but then next year they decide that hey, we like real estate even better, we want to buy it at a 5% cap rate. So they would be willing to pay even more for that property for that same amount of cash flow. So is that the same way to explain what you were saying? There's three different ways that we could make money from that one property.
No, that's exactly it. And we in our life, this was a few years ago, we bought a single family home. It was a university town. We converted it to a triplex. I sat for many years on our town's planning and zoning commission, so I sort of knew that process of how to get it sort of get a conditional use permit and go through that process. And at the end, we finished it, and it's like, well, let's go rent it out. And then when I looked at the value, that the cap rates had fallen for real estate in that town, so it pushed up the value, and I decided I'll just take my profits, because I don't want to wait around for the cash flow growth to grow over time, to have to raise rent over time. And so this can help us sort of decide, but it all comes down to what cash flow are we getting today, how will that cash flow grow, and then what are investors paying for that cash flow today versus what they might pay 3-5 years down the road.
So I have a follow-up question then. Like, one of the dynamics that a lot of real estate investors are complaining about and dealing with, and it's just the nature of the beast right now, is that pretty much across the country and maybe around the world, that because interest rates have been so low, because cap rates have gone down, they've been compressed. When we're buying into a market, like a lot of people listen to this who are in California, for example, and for them to buy a property they buy $1 million duplex in San Francisco that has a rent of $2,000, $2,000 per month. So the income component of their return is very, very low. Like they might have like a 3% cap rate or a 2% cap rate if they just paid cash for that. And so a lot of the expected return is coming from growth. And I think traditionally a lot of real estate investors, that just makes people nervous. Like, oh, well, I really want to make my returns from my income, not from the growth. And do you see that? I don't know, do you have a comment on that? Because I think there's kind of a divide even in the real estate investing kind of space of people who are like, no, we need to go buy income and we need to make most of our return from income. Others who are saying, hey, this is a new phenomenon. You're not going to make much cash flow. You just need to break even, or maybe even, have a little bit of a negative cash flow, and your money's going to be made on the growth. And I'm just wondering if you have kind of some feedback on it or thoughts on that.
Well, if we say the money's made on the growth, it really is, in that scenario, isn't even on the growth, it's being made on the leverage. So, the value of any real estate it's dependent on the rent. If it's a house, for example, it's, even though we don't think of it when you're buying your first house, but the value of the house is dependent on what an investor could make renting out that house. And so, no, investing in like a 2 to 3% cap rate and then leveraging up, to me, is highly risky. It always comes down to, what is the cap rate? It's just, the problem is we've gotten so used to really low cap rates. invested in a university housing project with a friend of mine, and he came to town and got to know him, student housing. Well, he died. Like he got a brain tumor and died within a matter of weeks. And the project was not even started yet, but we called capital. We all had invested, and there really wasn't. And this was my mistake. There wasn't in the documents a succession plan. It was sort of him, and that was it. So when his spouse brought on a new project team, and they were kind of going through, and this was a very experienced team, but they were kind of going through what if scenarios. Like, well, what's the return on the investment if this happened? Cap rates went up to 5% or 6%. And when I kind of went through that discussion, my question to them was, why is your worst case scenario 6%? Because I come from a world where I was used to cap rates of 9%, and we wouldn't invest in real estate unless you could get 8-9%. And the response was, well, we don't think that's going to happen. And if it did, then it would be an unprofitable investment. But cap rates or whatever that cash flow, that is the driver of real estate from my experience. And so if we're going to get growth, we can't depend on, when you're saying in that scenario is, okay, the cash flow yield's not there, the growth, investors paying more, basically that means we think cap rates are going to fall even further. Mm-hmm. I mean, that's just how the math works. If the rent stays the same and it's only a 2 to 3% yield, and we think the property is going to be worth 50% more, well, what happened is the cap rate fell. And what's the challenge in today's environment? Well, interest rates are going up. And how will that impact? In theory, that should cause cap rates to increase, which means the value of real estate will fall. And if you're highly leveraged, that's a risk.
Yeah. So it comes back to cash flow. It comes back to the value of real estate. And really what I've heard from any investment, that's what was an aha moment for me on this expected return, was even with stocks. I mean, stocks it's not the exact same situation, but it seems like, the trend has been to dividend rates are lower, even, multiples are higher. So this is like, it can kind of lull you to thinking, well, that's just the way it's just the new normal. That's the way it's going to be. But the history, if you look back at the history of companies and businesses and real estate, people buy earnings. That's why we invest in the thing in the first place. And so are we getting into the territory where you mentioned in the beginning, investment versus speculation versus gambling? Is it that some of the markets are becoming more speculative and not really having a foundation of investment earnings?
Well, right. You're seeing that. I mean, you saw that with what are known as the meme stocks, where there was no earnings. And you see it all the time in the venture capital space. So many companies go public. In the old days, 20 years ago, 15 years ago, companies that went public actually had a profitable business model. So they would go public, and they had take eBay, for example. It was making money. It was a growth stock, but it was making money. Now it's very common to do an initial public offering, so offer your shares to the public for the first time, and they haven't even figured out the business model. They're losing a ton of money, and the venture capitalists basically are saying, okay, the public market is willing to purchase this company because they want to buy this growth stock, but we haven't figured out exactly how we're going to make money yet. And now you're seeing companies that, so Peloton, for example, that's an example of the exercise bike video thing. They had a business model, but it wasn't a profitable business model. I mean, I know because they sponsored my podcast for many months leading up to the IPO. And then as soon as the IPO hit, they cut all their advertising. And now they're backpedaling big time because of the pandemic. People they don't want to sit around and ride a bike and watch a video. And so you see that with the stock market. What actually works, if you do historical studies, the best performing stocks over time are dividend paying stocks that are growing their dividends. So that's the best performing. The second best performing stocks are high dividend paying stocks. So maybe they're not growing their dividend, but they have a high dividend. Those are the two leading segments of the market. The worst, obviously, are those that are cutting their dividend, which you would expect. But the second worst are those that don't pay any dividends. And so if you look at historical studies, and the best are ones actually generating cash flow, paying that out to shareholders, growing that cash flow, then that's a successful investment. And that's how we should approach any investment. What's the cash flow? Is it growing? And what are we paying for it?
I just one notable exception came to mind for me. Just anybody who studies Warren Buffett, is the Berkshire Hathaway would be, one of those that doesn't pay dividends, and then I guess Apple, maybe a couple others too. Is the rationale there? I'm not saying people need to go invest in that company, but that you're letting them retain all the earnings. They're making strong earnings, but you're okay with them reinvesting that money that in the future they could pay the dividends. Is that, how do you look at something like that?
Exactly. That's how you look at it. It's sort of like, all right, we trust management to make investments. And obviously Warren Buffett has been able to do that, to where over time, the earnings per share is increasing from the actual investments. But if we look at across the board, those are exceptions. Most of the time, the companies that don't pay earnings underperform companies that actually do pay earnings or pay out dividends.
Got it. All right. So I want to segue a little bit. I'm going to keep my one foot in real estate as well. So I'm speaking kind of from personal experience, but I know a lot of people or listeners of this are very heavy real estate assets. That most of their net worth, or a large portion of their net worth, has been in real estate. And let's say somebody wants to start venturing off into some of these other asset classes. I want to go back to the asset garden idea. I feel like when real estate investors, they know what they're looking at, they know real estate, know how to run the numbers, but they also realize, all right, I'm geographically pretty isolated. I have most of my money in one geography, or one part of the country. I have most of my money in one asset class. How should we, or how could we maybe start thinking about adding to our garden? What are some of the big categories that we are often missing if somebody just has real estate and cash as their portfolio?
Well, at the simplest level, you can invest in one ETF. So the Vanguard Total Stock Market ETF that invests in U.S. stocks, but it also has a sizable weight to non-U.S. stocks. So real estate's just one asset class. And if you're just in one geography, you know it well. But wouldn't you want to benefit from the growth of capitalism around the world and sort of diversify it out? Or I'm not a big real estate investor because, part of it is, for me, when I've done projects, it takes a lot of work. And part of it was, in high school, I worked for a guy that had, my uncle had a boatload of real estate. That's what he did and built as well. And I worked for a guy that had real estate. And so I paint in his apartment buildings, I'm cutting his grass. This is a lot of work. Now you can hire a management company, but I've always liked the idea of making money with paper assets where I didn't have to get my hands dirty or even think about hiring other people to get their hands dirty.
Yep.
And so, one of the areas I invest in are called closed-end funds or other, and we don't necessarily have to get into that, but the idea is that there are investments out there where the returns are higher on an unlevered basis than real estate. And so and stocks is potentially an example of that. Or there's a whole range of potential asset classes that you learn them one at a time. But just start with stocks. Stocks are an attractive asset class that have generated positive returns. They've done well in periods of higher inflation. Over time, they're compounding, and just kind of focus on that aspect. What's the expected return based on its cash flow growth, and what investors are paying for it.
So we can apply a pretty similar, if we're familiar with looking at what we just talked about with real estate, you could, even if you're not a stock expert, you can look at one of these broad ETFs. You could do an estimate on what their earnings are. That information's available. You could say, these, for the price I'm paying, here's the total earnings. And then you could look up some information on expected growth or potential growth for the overall market and say, hey, this basket of stocks could have a potential return of 7% or something like that down the road.
Yeah, you could do that, or you don't even have to calculate it. So Research Affiliates is an investment manager. They have a website where they estimate the returns of different asset classes. And so you can look at, okay, well, here's the expected return of this particular asset class. It's something that we do in our membership community. Every 6 months, we estimate the expected return of a dozen or so asset classes over the next decade. And you're never going to get it exactly right, but what it allows you to do is sort of compare. So most people, they don't have time or the desire to figure out and calculate the expected return. But like a free resource like Research Affiliates, they do it for you, or we do it on our site, and that is really approach. But you can also just buy the entire global stock market and not figure out with different segment. Just buy the whole thing. It ends up being a smaller part to begin with, and just let those assets compound over time and diversify a little bit out of real estate.
It makes sense. So you start investing some of your cash flow, or you sell a property and you can invest some of those proceeds in that, and incrementally you can start getting a bigger part of your garden to be that other asset class. Yeah.
And it's hard. I mean, it's scary. We spent a lot of time living in Idaho, and one of the things I have found in the area of Idaho we live, it's mostly farmers, and they're growing potatoes, and they've built a lot of wealth farming. And what do they do when they get a bunch of assets, or they make money farming? What they end up doing is they just build a bigger house because they're so scared to invest in anything else. You see these farms, and then they just build a very big house on their farm because they're afraid of the stock market, and they don't understand the stock market. And we tend to be afraid of things we don't understand. And that's why we can slowly educate ourselves and learn about these other asset types till we get more comfortable with them.
Yeah, and I liked how you explained it earlier, David, because it kind of hits the way I think about these big, broad index funds. It's like, I don't understand what Apple's business plan is. I don't understand what some high-tech biochemistry company's business plan is, but I do get that capitalism over the entire world has a nice tailwind. There's human capital, there's people who are creating things, there's people managing things. And if I just say there's like thousands and thousands of companies in this entire world that I'm going to own a share in, do I believe that over the next 20 years, they're going to reinvest that money and do well with it? Like, I feel pretty good about that. Like, if I just put it that simply, and that's stock investing, that's equity investing right there.
Right. What you're doing, you're buying baskets of stocks. So you're not sitting there buying one company. And that's how I've always invested. So I bought individual stocks, but when you're buying an individual stock, whenever we buy any asset class, so you buy a piece of real estate, you want to know who's selling it to you. Why are they selling it? Why are they? The best scenario is a buyer that just wants to get out for whatever reason. But if you know that, that's really key information. Well, when you're buying a stock, most of the time it's some institution that's selling it to you. It's a hedge fund, or it's a long-only stock manager, somebody that knows something that we don't. And when we're buying an individual stock, we're basically saying the consensus of the market is wrong. I'm right. The stock is going to do better than what everybody already expects. And because otherwise, if it does worse than what everybody expects, then its price is going to drop. It's got to do better than what everybody expects. But when you're buying a broad index mutual fund, it's made up of thousands of stocks, some of which are going to do better than what people expect and going to do well, and some are going to do worse and won't do as well. But on average, everything cancels each other out to where what drives it is the cash flow growth, and what investors are paying. One of the examples I've used over the years is it's catching popcorn. So if you pop popcorn, you don't want to sit there trying to predict which popcorn kernel is going to pop first and catch it. No, what you're trying to do is, I just want a basket of popcorn and realize some are going to pop, some won't. I just want to catch it all. And that's what you do when you invest in an index fund. I just want exposure to all, recognize some will do better than others, but I don't have to predict which stock is going to do better than all the other ones.
Comparing investment baskets to food is always going to work with me. That's a good one. Love that analogy. So final topic I want to segue. This is one we could talk about a lot, but I at least want to touch on it because I know it's on a lot of people's mind. Is 2022 in the headlines, which is unusual because this hasn't happened in a while. Is inflation is something that people are worried about, and it's one of those risks that we always, we've had inflation and things happen, but it's been higher than normal. And so I would wonder if just from a lot of it's sensational as well. So I was wondering, just from your perspective, can you explain what inflation is, and then maybe how you're thinking about it from an investor who has your money out in the market as well?
Right. So what inflation measures, it's the cost of living increasing over time. So what statistical government agencies do is they, like in the Consumer Price Index, which is the measure of US inflation, there are over 200 categories of goods in that basket that represents how a typical American lives. And then they figure out what the price is of each of those goods. They add them all together and then they compare it to the previous period. And what we're seeing now is that price of that basket of goods has gone up 9% in the past year, which is the highest inflation rate in 40 years. So that's what it is. What causes inflation is a couple things. One, just more money in the system. And the primary driver of the inflation we're seeing today is there has been more money created. When we talk about money, we're talking about checking accounts, money market mutual funds, just more cash. And we have more money, and the amount of money has basically doubled in the last 10 years if we're talking dollars. And the way that it has happened, it happens through bank lending. When banks make a loan, they create a new digital deposit and there's more money in the system. But the other way is when a government runs a huge stimulus program like we did during the pandemic. A lot of money was handed out, but at the same time, typically if they hand out money, then they have to tax people, and then so the money comes in. So they offset each other. But central banks around the world, including the Federal Reserve, have been buying those bonds basically, they've been monetizing this stimulus. So the government is over here giving out money, and then the Federal Reserve is over here basically creating the money based on some accounting entries, and we don't have to get into the detail. But ultimately, we have more money. At the same time, what we've seen is we went through 2 years of pandemic where people weren't buying as much stuff. They were stuck at home. And so then when the pandemic eased, the economy the economy opened up, then suddenly people want to buy stuff. And they're buying houses, they're buying everything because they have more money, they have more savings, and they're bidding up the price of stuff. And then because the other thing that leads to inflation is capacity constraints. So if everybody goes out and wants to buy toilet paper, there's not enough capacity to do that, and the price goes up. Well, think about that across the entire economy. Used cars. Suddenly, everybody wanted used cars because there were capacity constraints in creating chips for new cars. So they weren't able to make as many new cars as to meet the demand. So people went and bought used cars instead, and the price of used cars increased 40% in a year. Well, that flows into the inflation calculation, and that's kind of what we're seeing. And so what the Federal Reserve and other central banks try to do to solve that is they start raising interest rates. So they raise what's known as their policy rate, which is very short-term interest rates, the Fed funds rate, and that flows through into higher interest rates. So now, I got a mortgage about a year and a half ago at 3%. Now, first time I've had a mortgage in a decade because it was so cheap. Now you go out and try to get a 30-year mortgage, it's over 5%. And so higher interest rates discourages people from borrowing and buying as much. And the idea is, well, okay, that will slow the economy a little bit. It'll reduce some of the demand. It'll ease some of the supply constraints, and that'll lower the rate of inflation. And hopefully, and they call that a soft landing. Hopefully that'll happen before we get some type of economic contraction, because everybody gets fearful. It's like, oh, rates are so high, I don't want to buy anything. Then companies stop producing, and then you can see an economic downturn.
Very well explained. And so, a lot of that's outside of our control. We're individual investors, and we can read the news, we can watch what's happening. Interest rates go up or down. Going back to the approach of being on the leading edge of information, we're listening to the weather forecast, and we have to decide what we do from here. But what types do we change our approach to investing because this phenomenon is happening, or how do we change it? I'm just curious how you look at it from a personal investor standpoint.
Well, if you're involved in real estate, I would do more sort of sensitivity analysis, like, oh, here's the cap rate. What would my situation be if for whatever reason the cap rate went up 3 or 4%? If I had to get out, was planning on selling in 3 to 5 years. Now, a lot of real estate investors can just hold on, which is perfectly fine. And so I think recognize we are in a higher inflation environment, but there are opportunities in the sense that we are getting more on cash now, the yields as the Fed raises rates, we can now lock in a CD or whatever and get higher yields, but just recognize that we're in an environment, and the biggest risk of this environment is the Fed doesn't get control of inflation, and investors begin to lose trust in the Federal Reserve, which means potentially they don't want to hold dollar assets anymore. And so then you could see the dollar start sinking. And then inflation can get even higher and it can kind of spiral out of control. Now, that's sort of a worst case scenario, but that's why we hold other assets. We hold non-dollar assets and that could be stocks, to protect against our home currency weakening significantly. Or we own other types of assets to protect ourselves. But in a very high inflation environment, it's a difficult place to invest, particularly if it's high inflation at the same time there's an economic contraction, which is what's known as stagflation. And that's a particularly challenging time to invest, because in some regards, like, there's no good asset classes. And hopefully real estate will hold up during that type of environment, because you're getting the rents because people have to live somewhere.
Right. Yeah. Well, to be continued. It's a conversation that has a lot of interesting twists and turns, but I really appreciate your kind of common sense fundamentals approach to personal investing, David. It's just been very helpful for me. And I think a lot of people listening to this are going to also benefit from that. I'm going to put a link to your book. I'm going to put a link to the Money for the Rest of Us podcast. I just want to close with a conversation that I always ask my guests, is that people listening to this are interested in financial independence. They want to save money. They're trying to build wealth. One of these days, they like to live off their investments, perhaps. But many of them find themselves just in the grind of doing it, of saving the money. And it might be hard to see the top of the mountain and where they're going. So I was wondering if you had any just final words of encouragement for them, or maybe a tip to leave them with that'll help them in their journey to financial independence.
Well, I think the trick is just to keep learning. So what I tell our kids is what you're doing is you're getting inventories of skills. So you're learning something new. You're learning something in a job. You're learning something outside, and suddenly we have all of these sort of skills, this inventory, and we'll find that over time, and we can combine them in different ways. Some opportunity unfolds that we didn't realize, we couldn't predict, but hey, we have the skills to actually take advantage of that. So I think if we just stay in the game, look at every job as an opportunity to learn, to improve, that, ultimately individuals that show initiative at work, that are learning new things, managers, they recognize that. At our investment advisory firm, it was clear, like, who actually liked investments. It was surprising how many people that were working in a firm that didn't even like investing. Whereas those that did, they excelled because they liked it, they were learning, they were growing, they came up with ideas. And I think if we feel like we're in the grind, well, go learn something new, go try a new skill, take some initiative. And you'll find that even though you don't know what you want to do with your life, that ultimately, as you build skills, that your path will unfold and you'll be able to combine them in novel ways.
Yeah, learning information and skills, pretty much something that compounds, maybe the better compounder than money, right? It's just such a...
All right, that's what human capital is.
Yeah, it's incredible. So thank you so much, David. I want to give you one final chance too to hand off where people can follow you or anything else you have going on in your world online.
Sure, just moneyfortherestofus.com. There's a lot of free investment guides if you want to learn about different asset types, asset categories, learn more about inflation. We have a free inflation course to help you learn more about that. And you can all find that at moneyfortherestofus.com.
Great. I will put a link to all that. And again, David, really appreciate it. Have a good summer. I know you're going out. I'm going out west as well, but I'm going kind of close to your territory up in Idaho, and we're going out to Yellowstone. And but hope you enjoy the rest of your summer, and hope we can connect again sometime soon.
That'd be great. Thanks, Chad.
Thanks, David. I hope you found this interview with David Stein as helpful as I did. And if you liked the episode, I want to invite you to join me next week for my Monday in-depth interview, this time with someone named Heather Lauder. And the title is From Homeless to financially free with 7 rental properties. You're going to be blown away by this story from Heather. When she was 18 years old, she was living in her friend's car. She was living in her own car after that, and she worked her way back up. And I'm going to leave all the story and the details to the interview, but you're going to want to hear this because the end of the story is she's living off her rental properties. She moved with her husband now to Taiwan, and the two of them are living in a totally different place. So just check that interview out. Lots of personal struggle and challenges and overcoming in that story, but also just lots of real estate tips too and money management tips. So be sure to listen to that episode. If you like the show, I'd like to invite you to subscribe to my free email newsletter at coachcarson.com/REI toolkit. In addition to weekly updates, articles, and behind-the-scenes tips from me, my email newsletter subscribers get my real estate investing toolkit, which includes a property closing checklist that I actually use when I buy properties, a real estate deal worksheet, a tenant screening criteria checklist, and other spreadsheets and goodies that will help you on your journey to financial independence using real estate. You can get it all for free at coachcarson.com/REI toolkit. I also want to take this time to thank some people behind the scenes who make this podcast possible each and every week. This includes my podcast editor extraordinaire, Michael Wynn, my amazing virtual assistant, Megan Thompson, my wife, Carrie, who helps me behind the scenes and is my partner here at Coach Carson. And of course, thank you to all of you, the listeners of this show who make everything possible. This show exists for you. It exists because of you. And I really appreciate you being here for another episode. Everything I've shared with you in this episode has been for general education purposes. I have not considered your specific situation or risks. Before buying your own investments, be sure to consult a financial, real estate, and/or a legal professional. Until next time, I'm Chad Carson. You can also call me Coach, and this is a show all about helping you get out of the financial grind so you can do more of what matters. See you next time.